Are you wanting to understand the basics of journal entries but feeling overwhelmed? If that's so, you are in the right place. In this video, I'm about to break it all down for you and make accounting a piece of cake. Hi there, I am Juliette, the creator of Concierge CPA, and in this video, I am going to explain accounting journal entries and break them down step by step. I will explain what they are, the types of journal entries. I will also go over examples of journal entries and explain the connection between journal entries and the general ledger. And I will walk you through creating your own journal entries. Whether you're a small business owner looking to manage your own finances, an aspiring accountant, or simply want to understand basic bookkeeping better, this video is for you. You don't need any prior accounting knowledge to follow along. By the end of this video, you'll understand the purpose of journal entries, their structure, the all-important debit and credit concept, and be able to create simple journal entries on your own. So let's get started. What are journal entries in accounting? Accounting journal entries may sound like a mundane topic, but in the world of finance, they are the bread and butter of financial reporting. Essentially, journal entries are the record of every financial transaction a company makes. Every single dollar that goes in or out gets jotted down in detail. These entries are the building blocks to preparing a company's financial statements, giving a clear picture of their financial health. So, while they may not make the juiciest conversation topic at a dinner party, they are essential for businesses looking to stay ahead of the curve. Every financial transaction that occurs in a business gets recorded as a journal entry, providing a chronological record of all transactions. They are the primary source of data for all other financial reports. Without journal entries, you may as well be sailing in the dark without a compass because you've got no way to track where the money's coming from, where it's going, or how it's affecting your business financial standing. The three main types of journal entries are debit and credit journal entries, adjusting journal entries, and compound journal entries. Debit and credit journal entries. As the name suggests, these are the backbone of any accounting journal. They form the basic building block of the accounting process, where each transaction is recorded with at least one debit and one credit. Remember, every debit has a corresponding credit. This ensures that our accounts are always in balance, reflecting the fundamental accounting equation: assets equals liabilities plus owner's equity. When you make a debit entry for an amount, somewhere else there is a credit entry waiting to keep things balanced. Next, we have adjusting journal entries. Adjusting journal entries are made at the end of an accounting period to update account balances before preparing financial statements. This aligns with the accrual principle of accounting, ensuring that revenues and expenses are recorded in the period they occur. An example of an adjusting journal entry is recording depreciation expense of an equipment. And the third one we are going to mention is the compound journal entry. Compound journal entries involve more than two accounts. They are used when a transaction affects multiple ledger accounts. For instance, as a sales transaction that includes both cash and credit elements will require a compound journal entry. In this way, all aspects of the transaction are accurately documented. Moving on to the structure of a journal entry. The structure of the accounting journal entry is simple, yet powerful. It contains 5 important components: a unique reference number for the journal entry to create an audit trail and for future reference. Next, the date of the transaction. This is crucial for maintaining chronological order of business events and aids in accurate record keeping. Next, we have the accounts and description. This section details the account involved in the transaction. It could be cash, accounts receivable, revenue, or any other account that might be affected. Next, we have the debit and credit columns. As we mentioned earlier, every transaction involves at least one debit and one credit, maintaining the fundamental accounting equation: assets equals liabilities plus owner's equity. So if one account is debited, another one should be credited for the same amount, keeping our accounting universe balanced. And lastly, a brief description of the transaction to maintain context for future reference. Let's take a look at these 3 examples. Assume that your company made a sale of $5,000. The journal entry for this would include a debit to accounts receivable and a credit to sales revenue, both for $5,000. This demonstrates that the company has earned revenue, but it has not yet received the cash. Purchase of supplies. Suppose your company purchases supplies worth $200 on credit. The journal entry will be a debit to supplies and a credit to accounts payable, both for $200. This increases the company's supplies while also acknowledging a liability to pay for those supplies in the future. Example number 3, paying off a liability. When the company pays off the $200 liability for supplies, it would debit accounts payable for $200, reducing the liability, and it will credit cash for $200, showing a decrease in the company's cash. In essence, these entries show the business's financial activity and affect the overall accounts by increasing or decreasing assets, liabilities, equity, revenue, or expenses. Now that we've examined some basic journal entries, let's uncover how these entries interact with the general ledger. The general ledger is essentially a collection of all the company's accounts. When we record a journal entry, these entries are subsequently posted to the general ledger. Each entry directly affects the balance of related accounts in the general ledger. For instance, when we recorded a sale of $5,000, we debited accounts receivable and credited sales revenue in the journal entry. In the general ledger, the accounts receivable account would increase by $5,000, indicating the amount the company expects to receive. The sales revenue account will also increase by $5,000, reflecting the revenue earned. So you see, journal entries provide the detail of each transaction, while the general ledger accumulates these details into a broader view of the company's financial health. Understanding this flow is paramount as it ensures accurate and consistent recording and tracking of a company's financial transactions. Now I will walk you through the process of creating your own journal entries in 3 easy steps. We will go step by step, so even if you're a beginner, you can follow along. Step 1. Identify the accounts affected. To start off, you first need to identify all the accounts that are affected by the business transaction. Step 2. Determine the account types. Once you've identified the accounts involved, determine if they are assets, liabilities, equity, revenue, or expense accounts. Understanding the type of accounts involved is crucial for the next step. Step 3. Apply the debit and credit rules. As a general rule, increase in assets and expenses are recorded as debits, while increases in liabilities, equity, and revenue are recorded as credits. This is where memorizing the expanded accounting equation becomes very useful. Remember, DEA equals LER. DEA are increased by debits. LER are increased by credits. Just as a reminder, debits always go on the left and credits always go on the right. Step 4. Record the journal entry. You are now ready to record the journal entry. The format is simple. You start with a unique reference number for the journal entry. You record the date, the accounts affected, the debit, followed by the credit, and finally a brief description of the transaction. Remember, practice is key when it comes to creating accounting journal entries. The more entries you make, the more comfortable you will become with the process. And that is all for today's video. I hope you now have a better understanding of accounting journal entries. If you found this video helpful, hit that like button and subscribe for more accounting insights. Thank you for watching. See you next time.